So let's talk about the energy market. If you've paid any attention lately, you know it's just chaos, right? It feels like this constant whirlwind of geopolitical headlines, crazy supply shocks, and prices that are just all over the map. It can feel totally impossible to find a clear path. So in this explainer, we're going to cut right through that noise. We're going to figure out how to invest strategically when the world seems dead set on throwing us curveballs.
Okay, let's just dive right in. I mean, look at this timeline. The last few years have been a complete roller coaster. We went from a total demand collapse during the pandemic to this massive price spike when the war in Ukraine started. But here's the really interesting part. What's been happening lately? Even with these huge geopolitical events like the whole U.S.-Venezuela crisis, the market's reaction has been surprisingly quiet. This really sets the stage for the kind of chaos we're trying to figure out.
So that's the big question, isn't it? In a market that's this unpredictable, how do you actually make a smart strategic choice? Look, it's not about finding some magic bullet. It's really about understanding the different tools you have at your disposal.
And that is where our toolkit for today comes in. We're going to break down 3 of the most popular energy ETFs out there. A good way to think about them is like different tools in a toolbox. Each one is designed for a very, very different job.
All right, so meet our 3 players, XLE, XOP, and OIH. And I love these analogies. Think of XLE as the big, steady battleship. Then you've got XOP, which is more like a fleet of nimble explorer ships, the ones out there actually finding the oil. And then there's OIH. That's the essential support crew that makes the whole operation possible. Each one has a totally unique role to play.
First up, let's talk about that battleship XLE. If you're building an investment fleet, this is probably your core holding. It represents the biggest, most established names in the U.S. energy sector. And it's really designed for broad, stable exposure to the whole industry.
Now, check this out, because this is what really makes XLE tick. It's market cap weighted. All that means is the biggest companies have the most influence. And when I say influence, I mean it. As you can see, we're talking over 40% of this entire fund is just 2 companies, ExxonMobil and Chevron. So when you buy XLE, you're really making a big bet on the industry giants.
Okay, so let's shift gears from the giant battleship to our more nimble explorer ships. This is XOP, and it is a completely different animal. This is a specialist fund. It focuses only on the companies that are actually out in the field exploring for and producing oil and gas, what the industry calls the E&P sector.
And this is the key difference, the secret sauce of XOP. Unlike XLE, it's equal weighted. That means the smaller and mid-sized producers have just as much say in the fund's performance as the big guys do. What that does is it makes the entire fund much more sensitive to the direct profitability of, actually pulling oil out of the ground. And as we're about to see, that gives it a very, very different risk profile.
And of course, no fleet is complete without its support crew. And that's where OIH comes in. This ETF holds the picks and shovels of the energy world. We're talking about the companies that provide the drilling rigs, the equipment, and all the services that those producers in XOP absolutely rely on to get their jobs done.
This slide really gets to the core of what OIH is all about. An investment in OIH isn't really a direct bet on oil prices. It's a bet on activity. Its performance is tied directly to things like capital spending budgets and how many rigs are active in the field. So when energy companies decide to open up their wallets and spend big on new projects, OIH is designed to soar. This makes it a highly cyclical, think boom and bust type of investment.
Okay, so we've met the team, we know who the players are, now it's time to open up the playbook. Let's put these ETFs side by side to really understand the strategic trade-offs here. This is how we'll figure out the right choice for our strategy.
And this table just lays it all out perfectly. You've got XLE, giving you that broad exposure to the integrated giants. It's best for a core, long-term position. Then you've got XOP, a more tactical tool for betting specifically on the producers themselves. And finally, OIH, which is a highly targeted, cyclical bet on industry spending. See? 3 different tools for 3 very different jobs.
Now, this chart really spells out the risks that comes with each of these strategies. No surprise, XLE, our battleship, offers the smoothest ride, the lowest volatility. XOP, with all its smaller companies, definitely ratchets up the risk. But OIH, the support crew, is by far the most volatile of the bunch. And the reason for that is so important. When oil prices fall, what's the first thing to get cut? Capital spending budgets.
And that hits these service companies the absolute hardest.
So at the end of the day, it all boils down to this fundamental choice you're making as an investor. On one side, you have XLE. It's lower cost, it has a higher dividend yield, and it's perfectly suited as a long-term core holding. On the other side, you have XOP and OIH. These are tactical tools. They're designed for cyclical trades where your main goal is growth, not necessarily income.
All right, we've analyzed the tools in our toolkit. We understand the playbook. Now let's bring it all back home to where we started, today's chaotic market. Which one of these is the right tool for the job in this current 2026 environment?
That brings us to this really interesting idea some analysts are calling the coiled spring scenario. The concept is pretty simple. So much bad news, fears of too much supply, worries about slowing demand, all the geopolitical risk, it's all already baked into the price of oil. The spring is being pushed down, compressed. That means any little piece of good news, any unexpected catalyst could make it snap back with a really sharp, powerful move up.
So, here it is, the bottom line. Despite all the doom and gloom in the headlines, West Texas oil seems to have found a solid floor, right around $56 a barrel. With so much negativity already accounted for, the whole risk-to-reward picture has shifted, and it's looking much more favorable for investors.
Look ahead, a lot of analysts are actually predicting a recovery. And a sustained move like that in oil prices, that is the exact catalyst you need to kickstart that oil services profit chain we walked through earlier. And that brings us to the punchline. Look, having a core holding in something like XLE makes a ton of sense for any long-term investor. But if you were looking for that tactical edge, if you want to capitalize on this coiled spring idea, OIH is positioned to benefit the most. If oil prices start to climb and producers open up their wallets again, the oil services sector has the most potential for really explosive growth.